How does the CRA define a taxable supply for foreign businesses? Understanding what the Canada Revenue Agency (CRA) considers a taxable supply is crucial for US businesses selling goods or services into Canada. The concept determines whether your business must register for GST, HST, charge tax, remit tax, and file returns. Because the CRA applies this definition broadly, many foreign suppliers discover their activities qualify as taxable supplies even without physical presence in Canada. A taxable supply is any commercial activity involving goods or services that are not exempt or zero rated. For non-resident businesses, the key question becomes whether their supplies are considered made in Canada and therefore taxable. GST HST applies to most commercial activities. Canada's tax system is designed to apply GST HST broadly to ensure neutrality between Canadian and foreign suppliers. This means that the CRA examines what is being supplied, where the supply is made, and whether the business operates in a commercial context. Taxable supplies include sales of goods, sales of services, digital and electronic supplies, software and SaaS, rentals and leases, certain rights and intangible property. Unless specifically exempted by law, these supplies are taxable when made in Canada. Place of supply determines whether the supply is taxable. The place of supply rules dictate where a supply is considered to occur. For foreign businesses, it is not where the business is located, but where the customer receives or uses the supply. If the supply is considered made in Canada, it is generally taxable. If the supply is made outside Canada, GST HST may not apply. This evaluation depends on delivery location, customer residence, and the nature of the supply. Here are the key factors the CRA uses to classify taxable supplies. Whether the supply is made in the course of commercial activity, whether the recipient is located in Canada, whether goods are delivered inside Canada, whether services are performed in whole or in part in Canada, whether digital services are consumed by Canadian residents. If these conditions are met, the supply is typically considered taxable. Exempt versus zero-rated supplies. Not every supply is treated the same. Some are exempt, meaning no tax is charged and no input tax credits (ITCs) can be claimed. Examples include certain health services, financial services, and residential rent. Other supplies are zero-rated, meaning tax is charged at 0% but ITCs can be claimed. Examples include basic groceries, prescription drugs, and certain exports. Foreign businesses often misunderstand the difference. Zero-rate status allows ITC recovery, but exempt status does not. Digital supplies automatically taxable in most cases. Digital services such as SaaS, apps, online courses, and downloads are almost always taxable supplies. Canada focuses on the customer's location. If a Canadian resident uses or accesses a digital product, the CRA considers that supply taxable even when the business operates entirely outside Canada. This is one of the most common reasons foreign businesses must register for GST HST. Goods and import rules. For goods, the CRA evaluates where delivery occurs. If goods are shipped to a location in Canada and the supplier acts as importer of record or uses Canadian inventory, the sale is a taxable supply. If the Canadian customer imports the goods themselves, the sale may not be a taxable supply made by the foreign business. Understanding this distinction determines whether GST HST registration is required. A practical example. A US educational software company sells subscription access to Canadian students. Even though the company operates entirely in the United States, the digital service is consumed in Canada, making it a taxable supply. Registration becomes mandatory. Meanwhile, a US retailer shipping artwork to a Canadian buyer may not have to register if the buyer is importer of record and the retailer maintains no Canadian operations. In this case, the supply may be considered made outside Canada. Final thoughts. The CRA defines taxable supplies broadly to ensure tax neutrality across domestic and foreign businesses. By understanding how Canada classifies goods, services, and digital supplies, US businesses can determine whether they must register for GST HST and comply with Canadian tax rules. The distinction between taxable, zero-rated, and exempt supplies plays a central role in compliance planning. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.